Have you ever wondered how to start investing in the stock market? Well, you're not alone. Many folks are intrigued by the idea of investing, but often feel overwhelmed by the complexities of the stock market. That's why we're here today, to demystify the process of investing and break it down into manageable, step-by-step chunks. In this video, we're going to take you on a journey, starting from the very basics of understanding what the stock market is, all the way to making your first investment and regularly monitoring your portfolio. We'll talk about the importance of financial education, setting clear investment goals, and how to choose the right brokerage account. Our goal is simple: to equip you with knowledge and confidence so you can navigate the world of investing with ease and assurance. Remember, everyone starts somewhere, and today could be the day you take that first step. By the end of this video, you will have a clear understanding of how to begin your investment journey. So what exactly is the stock market? Think of it as a bustling marketplace, but instead of fruits, vegetables, or clothing here, companies and investors trade stocks. A stock represents a slice, a share, of a company. By purchasing stocks, you are buying a piece of that company, becoming a part owner, so to speak. The stock market is not a physical place, but a network of exchanges where these transactions occur. Prominent examples include the New York Stock Exchange and the NASDAQ. These exchanges ensure that the buying and selling of stocks are conducted in an orderly, transparent, and fair manner. Now you may ask, why do companies sell stocks? Well, they do this to raise capital. When a company decides to go public, they sell a portion of their ownership in the form of stocks. This capital can then be used to fund new projects, pay off debts, or expand the business. And what's in it for the investors? As shareholders, they stand to benefit in two ways. First, if the company performs well, the price of the stock may rise, and they can sell their stocks for a profit. This is known as capital gains. Second, some companies distribute a portion of their profits back to the shareholders in the form of dividends. However, investing in the stock market is not without risks. Stock prices can go down as well as up. If a company underperforms or faces a crisis, the stock price may fall, leading to potential losses for the shareholders. Despite these risks, the stock market plays a crucial role in the economy. It enables companies to grow and innovate, creating jobs and wealth in the process. For investors, it provides an opportunity to grow their savings and achieve financial goals over the long term. Remember, the stock market is not a get-rich-quick scheme. It requires patience, discipline, and a keen understanding of market dynamics. It's like a game of chess, where strategic moves can lead to success. A thorough understanding of the stock market is the foundation of any successful investment strategy. Before diving into the stock market, it's crucial to educate yourself about finance and investing. Imagine going on a journey without a map or a compass. Sure, you might stumble upon some interesting spots, but chances are you'll get lost or end up somewhere you didn't intend to. The same applies to investing. Without a solid financial education, you're essentially navigating the intricate world of investing blindfolded. So why is financial education important? Well, to put it simply, it's the foundation upon which successful investing is built. Understanding financial terms and principles is like learning a new language. It allows you to comprehend the market's conversations, to make sense of news and reports, and to speak the same language as other investors and advisors. Let's talk about some of these key financial concepts. Terms like dividends, capital gains, and price-to-earnings ratio are not just fancy jargon. They are fundamental concepts that can help you evaluate a company's performance and potential for growth. For instance, understanding dividends helps you know how a company rewards its shareholders. Capital gains is about understanding how your investment grows over time, and the price-to-earnings ratio, it's a tool to compare the prices of different stocks relative to their earnings, giving you a sense of whether a stock is over or underpriced. But financial education isn't just about understanding terms. It's also about learning how to analyze a company's financial health. Reading balance sheets, income statements, and cash flow statements might seem daunting at first, but these documents are like a company's report card, revealing its strengths, weaknesses, opportunities, and threats. Remember, knowledge is power. The more you educate yourself, the more you'll understand the risks and rewards associated with different investment options. The more you know, the better you can anticipate market trends and fluctuations. The more you learn, the more you can avoid common pitfalls and mistakes. And the beauty of financial education, it's a lifelong journey. The financial world is dynamic, always evolving, and as it changes, there's always more to learn. The more you learn, the better equipped you'll be to make informed investment decisions. Now that you're armed with knowledge, it's time to set your investment goals. Indeed, setting clear, achievable investment goals is an essential step in your journey to financial independence. It's the compass that guides your investment decisions, keeping you on track amidst the unpredictability of the stock market. Think of it as embarking on a road trip. Without a destination, you might enjoy the ride, but you'll probably end up lost, wasting time and fuel along the way. Similarly, without a clear investment goal, you might make a few good trades, but you'll likely miss the bigger picture of building long-term wealth. So, how do you set these goals? It starts with understanding your personal financial situation. This involves evaluating your income, expenses, savings, and debt. Once you have a clear picture of where you stand financially, you can determine how much you can afford to invest. Next, consider your financial goals. Are you saving for retirement, a down payment on a home, your child's college education? The timeline for these goals will influence the type of investments you make. Short-term goals might require safer, more liquid investments, while long-term goals allow for more risk and potentially higher returns. Risk tolerance is another crucial factor to consider. This is your ability to endure losses in your investment portfolio. If the thought of losing money keeps you up at night, you might want to stick to low-risk investments. On the other hand, if you're comfortable with some level of risk for the potential of higher returns, you could consider more volatile investments. Lastly, remember to be realistic and flexible with your goals. The stock market is unpredictable, and there will be times when your investments underperform. It's important to stay patient and adjust your strategy as needed. Remember, investing is not a get-rich-quick scheme, but a way to grow your wealth over time. It's a marathon, not a sprint, and setting clear, achievable investment goals is your first step toward the finish line. To start investing, you'll need to open a brokerage account. Now, you might be wondering, what exactly is a brokerage account? Quite simply, a brokerage account is an arrangement that allows an investor to deposit funds and place investment orders with a licensed brokerage firm. Think of it like a bank account, but instead of just holding your money, it's a platform where you can buy and sell investments like stocks, bonds, and mutual funds. It's your ticket to the financial marketplace. So, how do you choose the right brokerage account? Well, it's essential to consider a few key factors. First, consider the costs. These can include commissions on trades, account maintenance fees, and other charges. Some brokerages offer commission-free trades, while others may charge a small fee. Be sure to understand these costs up front. Secondly, consider the services and tools provided. Different brokerages offer different resources such as research tools, financial advice, and customer service. If you're a beginner, you might want a brokerage that offers educational resources and easy-to-use tools. Third, consider the brokerage's reputation and reliability. You want to entrust your money to a reputable institution. Look for brokerages regulated by top-tier authorities and those with a proven track record. Finally, you'll want to consider the account's ease of use. Since you'll be managing your investments through this platform, it's crucial to find one that you find intuitive and comfortable to navigate. Once you've decided on a brokerage, the process of opening an account typically involves providing some personal information such as your name, address, and social security number. You'll also need to answer some questions about your investment goals and risk tolerance. This information helps the brokerage provide you with suitable investment options. Remember, there's no one-size-fits-all brokerage account. What works best for you depends on your individual needs and circumstances. Don't rush this decision. After all, this account will be your vehicle for navigating the world of investing. Take your time to choose the right brokerage account that aligns with your investment goals and needs. Scene script. Congratulations, you're now ready to make your first investment. Investing in the stock market is a journey, and like any journey, it begins with the first step. That first step is selecting the stock you wish to invest in. This decision should be based on careful research, not on hunches or tips from friends. Look at the company's financial health, its past performance, and its future prospects. Consider whether it aligns with your investment goals and risk tolerance. Once you've selected a stock, it's time to place an order. In your brokerage account, you'll need to specify the stock you want to buy, the number of shares, and the type of order. There are two main types of orders. A market order, where you buy the stock at its current market price, and a limit order, where you specify the maximum price you're willing to pay. Choose the one that best suits your investment strategy. After placing the order, you'll need to monitor your investment. This doesn't mean obsessively checking the stock price every few minutes. Instead, keep an eye on the company's performance, the overall market trends, and any news that might affect the stock's value. Remember, investing is a long-term game. It's normal for stock prices to fluctuate in the short term, so don't panic over every dip. However, monitoring doesn't mean being passive. If your investment isn't performing as expected, or if your financial goals or risk tolerance change, don't hesitate to adjust your portfolio. Sell underperforming stocks, buy more of the ones that are doing well, or diversify into different sectors or types of investments. At the same time, don't get carried away by short-term gains. Greed can lead to rash decisions, just as fear can lead to selling at a loss. Stay calm, stay focused, and stick to your investment plan. Remember, patience is key when investing in the stock market. It's not about getting rich quick, but about building wealth over time. So take that first step, make your first investment, and embark on your journey towards financial independence. Investing in the stock market isn't a set-it-and-forget-it kind of deal. Like a well-tuned orchestra, your portfolio requires regular attention and fine-tuning to keep it in harmony with your financial objectives. Imagine your investment portfolio as a garden. It starts with a plan. You plant different types of seeds, stocks, bonds, mutual funds, and more. Over time, these seeds grow at different rates, some might even wither. Similar to a gardener who regularly checks and adjusts his garden based on the growth of plants and changes in weather. As an investor, you need to keep an eye on the growth of your investments and the changes in the market trends. This is what we call portfolio rebalancing. Why is rebalancing important? Well, the market is a dynamic entity, always in motion. Some investments may grow faster than others, causing a shift in your portfolio's original asset allocation. This can expose you to a level of risk that's either too high or too low for your financial goals. Rebalancing helps to realign your portfolio with your targeted asset allocation and risk tolerance. Moreover, life changes. Maybe you got a promotion, or you're planning to buy a house, or perhaps you're nearing retirement. These personal financial changes can significantly impact your investment goals and risk tolerance. Therefore, it's crucial to adjust your portfolio to reflect these changes. So, how often should you rebalance? There's no one-size-fits-all answer. It depends on various factors such as your investment goals, risk tolerance, and market conditions. However, a good rule of thumb is to review your portfolio at least once a year, or whenever there are significant changes in your financial situation. Remember, the goal of regular monitoring and adjusting isn't to chase the highest returns, but to ensure that your portfolio continues to reflect your investment strategy and risk tolerance. It's about staying the course, even when the market gets stormy. Regular monitoring and adjusting will help you keep your investment strategy on track. Investing in the stock market can seem daunting, but with the right knowledge and approach, it can be a rewarding journey. That's the message we've been driving home in the last 14 minutes or so. Let's take a moment to recap the vital steps we've covered. The first step is understanding the stock market. Remember, it's not a complicated entity. It's simply a place where buyers and sellers meet to exchange shares of companies. It's like a marketplace, but for shares. And like any marketplace, prices fluctuate based on supply and demand. Next, we talked about the importance of financial education. You wouldn't go into a new job without any training, would you? So why would you jump into investing without understanding the basics? Financial education is your training for the stock market. It gives you the tools you need to make informed decisions and, ultimately, to succeed. Then we moved on to setting investment goals. These are your personal benchmarks, your target returns, your reason for investing. They provide direction to your investment journey and help keep you on track. Just remember that these goals should be realistic, measurable, and aligned with your risk tolerance. Choosing the right brokerage account was our next point of discussion. This is where your stocks will live, so it's vital to choose a platform that suits your needs. Look for low fees, a user-friendly interface, and good customer service. Then the exciting part, making your first investment. Remember, it's not about timing the market, but time in the market. Start with companies you understand and believe in, and let the magic of compounding do its work. Finally, we stress the importance of regular monitoring and adjusting your portfolio. This isn't about trying to beat the market, it's about ensuring your portfolio aligns with your investment goals and risk tolerance. Remember, a well-balanced portfolio is a successful portfolio. Remember, every successful investor started somewhere. Your journey begins here and now. And with the knowledge you've gained today, you're well on your way to becoming a savvy investor.